Okay, so this time we've got two different mortgages for the same house. Chang wants to do, as in, I think it's like Shang Cheng or something, wants to do a $263,000 mortgage. That's how much he's going to borrow. And there's two different ways of doing it. There's the online lending company, and there's the savings and loan association. Now, they made this problem kind of easy. Both of them are 30-year mortgages, okay, which is really standard. Although you can do a 20 or even a 15. Your payments go up as the amount of time decreases, but you pay less in interest. Everything's the same. You make monthly payments. It's 30 years. You are same loan amount. The only difference is the interest rates. Well, the one with the bigger interest rate, of course, that one is the one you're going to spend more on. Okay, and therefore online lending would be the better deal. Okay. So let's get to it here. So here's our formula to figure out what that monthly payment is going to be. So I gotta turn this thing on. All right. Wow, it's a lovely straight line. So it's $263,000 for P, the beginning amount owed, and then times the interest rate, which is going to be, I think it was 0.033, is that right? Yeah. Okay, and then over 12 payments per year, divide that by 1 minus 1 plus. Same fraction, 0.033 over 12 raised to the negative 12 times 30, as in 30 years. And Shazam, that would be $1,151.82. Okay. So, and so we got that. All right. Now for the second mortgage or the second loan, all you have to do, the only difference, like I said, is instead of 3.3% interest, it's 3.6. That's it. That is the only difference. Okay. And so you type that in. And what do we get? And of course, this is there's more interest being charged against you. $1,195.72. Okay. And so, okay, we're done with that guy. And so, yeah, it's going to cost a little more each month. It's going to cost an extra, what is that, $14.20, something. So, then it says, okay, so how much more are you going to pay total? Well, it's not too much more. So, I mean, it probably doesn't make a big difference, right? Well, maybe. Okay. So, the difference is $1195.72 for one. That's the monthly payment for one of them. Let's find the monthly payment for the other. Okay. And well, read that. So yes, so $11.90. So $43.90. That'll be the difference. Oh. Wrote this not quite. I don't know where that. I don't know why I had that. There we go. Yeah, $1151.82. That is what it was supposed to be. All right. So $43.90 every month. Okay. So how much more do you pay? Well, each month, $43.90, 12 times a year for 30 years, $15,804 is how much more you pay over the life of the loan. So just a little
difference in that interest rate, yeah, you're paying almost $16,000 more over 30 years. Um, and so obviously that is not the direction you want to go. At least not the direction I want to go. And that's how it's done.
Okay, on this one, reading stock quotations. Okay, there's a decent chance you are going to do this at some point in your life if you haven't already. So what does this button do? Nothing important. Okay. So let's just kind of talk about this a little bit. So first of all, what are stocks? Okay, so let's say that Fred has a company, and or he's got a business. So he's, I don't know, he sells widgets, and so and his business keeps growing and growing. At some point, he says, "I want to go public." In other words, he will make his business available for people anywhere to invest in it by buying stock in the company. Every time you buy one little piece of stock, that means you own one little piece of the company. There are 100 stocks available for the company, and you buy 2 of them. Then you've got 2 out of 100, or you own 2% of the company. 100 stocks is very, 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 very small for a company. Usually it's going to be more like in the millions. But anyway, so that's kind of what's going on there. So so this first thing here, year to date percent change. So since the beginning of the year, what percentage has the price of the stock changed? Well, for this stock, it's positive 3.37%, so it has gone up 3.37%. Okay. 52-week high. Well, in case you weren't aware, there are 52 weeks in a year. So when they say 52-week high, they mean over the last 52 weeks, the last year, what was the highest price of the stock and what was the lowest price of the stock? And that kind of gives you an idea of, okay, well, if the 52-week high is $40.39 and the price of the stock right now is $40.10, you might, maybe you think to yourself, it could go a lot higher, but it's already close to the highest it's been in the last year. So who knows? Maybe it won't. Okay. EPS stands for earning per share. So what kind of earnings per share? A share is each individual piece of stock of the company you own. PE ratio, that's price to earning ratio. So you take the price, divide it. Well, this automatically takes the price, divides it by the earnings. That gives you a ratio, and then that, as you become more familiar with this stuff, that gives you information. Close price. So what the last time that the market was open, like New York Stock Exchange or S&P 500 or whatever, at what price did the stock to each individual piece of stock, each share of the company end at? So when they closed trading for the day before, well, it was $28.73. Anyway, so there's a lot of things there that you can check out. Okay, and then they've also got another one is net change. So that'll be the difference between the closing price yesterday, $28.73, and the closing price today. So it's a positive $1.11. So it went up $1.11 ultimately, if you only look at the closing price from yesterday and today. Now, during today, before it closed out $1.11 up, it might have fluctuated massively, or very possibly didn't fluctuate all that much. But there likely was some fluctuation there. Okay, so what percentage of change was there? Well, that'll be this 3.37%. And notice there's a percent sign there, so we're not going to write it as a decimal. We'll write it just like that. And the lowest price paid, that's that 52-week low, $10.56 in this case. And the difference, well, that's what net change means.
right there. And that's all we do for it.
Okay, so on this one, during 2021, Donald Young purchased 325 shares of common stock issued by Atlantic Carpet Mills for $11,500, including commission. So he bought 325 shares, 325 individual pieces of the company. Again, presumably out of millions, or at least thousands. Now he spent a total of $11,500, and yeah, included commission, but commission is usually pretty small. Like if you go to TD Ameritrade online or something, it's like $10 to make the purchase. And so you make an $11,500 purchase for 10, and then you spend an extra 10, you don't even notice it. Okay. All righty. So okay, so 325 shares of common stock. And so I mean, if we did 11,500 divided by 325 shares, that would tell us, okay, each share when he bought them was about $35.38 per share, approximately. Anyway, that's not what they're asking for. So they say, what is the profit on the stock transaction? So he walked away with 13 grand. He spent 11,500. So 13,000 minus 11,500 is $1,500. Okay, so when they say what's his profit, it's just how much more do you have? Now, if he lost money, then we would have stuck a negative sign there. Like if he had lost 1,500, if he ended up with only 10,000, then it would have been, if he'd sold it for $10,000, then he would have had a loss of 1,500. Okay, what is the percentage return on the investment? Okay, well, when we want to know the percentage of things, we typically want to divide by the starting amount. Okay. So we're going to go, so we're going to divide by our starting amount of $11,500. And then and then on top of our division, we're going to have how much money he made, about 1,500. And that's 0.1304 or 13.04%. And that's, again, just goes back to things we've seen in this class in the past. You want to know the percentage of something? Divide by or compare with the original amount or the starting amount. Okay. Okay. So let's talk a little more about stocks. For 2021, the annual earnings for North Carolina Furniture Company were $6.6 million. Okay, now that's earnings. That's before they start paying employees, paying to keep the lights on, paying for the land, paying for product, paying for shipping the product, and a bazillion other things. So it's not like, wow, they made a ton of money, they're just going to pocket it. It's like, no. The corporation has 3,479,900 shares of common stock outstanding and pays an annual dividend of 31 cents per share. So for each one of these shares, each one of these pieces of the company, they'll pay out 31 cents. Okay, so if you've got a lot of these, you might get a lot of money. Okay, the closing price for a share of common stock was $36 last night. So find the following. Okay, so the current yield, that's just going to be whatever you're going to get for your dividend per share, not total. And we're going to divide that by the last price, the last closing price. And that's going to be 0.0086 or 0.86%. Okay. And that's current yield. And of course, the larger your current yield, the more that suggests that your company is healthy. Okay. All right. Okay, another way of getting an idea of how well a company is doing is examining its earnings per share. Well, and so you do exactly what the name says. You take the earnings of the company, 6,600,000 in this case, and then per means divide. So divide by the number of shares that are currently outstanding. Okay, and in this case, we're going to get 1.896, blah blah blah, and that's going to round off to 1.90 because notice it's the units are dollars, and so we just want to go to the nearest hundredth, which is cents. So 1.90 dollars, $1.90. And of course, the higher that number is, the more that suggests that the company is doing well. Okay, the last one we're going to look at on this particular topic to give us an idea of how well a company is doing. Do we want to invest in it? Do we want to buy shares in it or not? Is the price to earnings ratio. Okay. So this guy right here at the bottom. Sorry. Okay. So to do that, what you do is you take the last closing price, and it's priced to, it's a ratio. So, ratio suggests division, something compared to something else. And then you're going to divide that by the earnings per share. Okay. And that gives us 18.947, or rounded off 18.95. And that's what you do. Again, yeah, you want a good, healthy price to earnings ratio. Now, these are very common things to be looking at to determine, do I want to buy this stock, or do I want to sell this stock that I've already bought? They're certainly not the only things, and you can, if you examine these things, study them a little more, and other things that we're looking at in this chapter, you can definitely learn more. Or maybe find a good book about these things, or talk to people who have been successful, people you trust that have been successful with the stock market. It's very easy to buy and sell. It's not like the old days where if you want to buy or you want to sell, you have to call up your broker. You just do it from your phone, of course. And you can also, one thing that's also really nice is you can set up triggers so that, if right now the price of the stock is $36, and then you might say, all right, when the price gets to $41.38, sell half of my stock in that company, or sell all of it, or 60%, whatever. Or when the price gets down to $34.29, sell my stocks. Okay, I don't want to take more of a bath than I'm going to have to, whatever. Or you can say, hey, when the earnings per share gets to a certain point, up or down, sell or buy this much. And so those triggers will go on. They'll just be automatic. So when it gets to that price, it just boom, it just happens, and then you don't have to worry about constantly checking the price of your stocks that you're interested in. Okay, for this last topic, I'm going to use what the author has said, because he says it really well. So last year, Frank Henderson purchased $1,000 All-Star Development Corporate bond with an annual interest rate of 6.75%. So this is not the same thing as stock. The bond's current market is $890. Calculate the following. Okay, the annual interest and the current yield. All right, so corporations have two methods of raising money: selling stock or selling bonds. A company may not wish to sell more stock and thus dilute the ownership of the current stockholders. So if you just keep selling tons and tons and tons of new stocks, then what the people who already own the stock, what happens to them is, instead of them having like 1% of the company, now they're down to 0.5%, and they're down to 0.25%, and maybe 0.1%, and they haven't done anything. They're still hanging on to the stocks that they bought a while back. And so if you just keep creating more and more new stocks, that can really throw things off your company. And then your stockholders might say, nuts to this, and then they'll sell, and then that'll cause problems for your company. So you have to be careful. Okay, so a corporate bond is a corporation's written pledge to repay a specified amount of money on a specific maturity date or end date for that bond, along with interest until maturity. If you purchase a bond with a face value of $1,000 and a stated annual interest of 6.75%, which is what's going on here, you will receive $1,000, so the face value times the percent, $67.50 each year until maturity. Okay, so all right, so that's kind of how that goes. Okay, now most beginning investors think that $1,000 bond is always worth $1,000. In reality, the market price of a bond fluctuates because of changes in the overall interest rates in the economy. So, for example, when overall interest rates in the economy are going up, which they are right now, this is currently August 2022, then the market price of an existing bond with a fixed interest rate will go down, and vice versa. Okay, when a bond sells for less than its face value, it is said to be selling at a discount. Ouch. On the other hand, when overall interest rates are going down, the market price of a bond goes up. When a bond sells for more than its face value, we say it's selling at a premium, so discount. Okay. Blah, blah, blah. Okay, so we already saw how to answer the annual interest. Okay, so how much interest do you, the bondholder, the person who bought the bond, how much interest are you getting every year? Well, that was the face value of the bond multiplied by the interest rate for the bond. And then so $67.50 each year. So if the bond's worth more, you're going to get more. If your percent, if the annual interest rate that you set up is more, then you're going to get more. Okay, and vice versa. Okay, so they've got that. Now, what about the current yield? To calculate the current yield, divide the annual interest. So that's $67.50. We're going to take that, and we're going to divide that by the current market price, not the face value of $1,000, but the current market price of whatever it is right now, today. And remember, those prices, they tend to fluctuate just throughout the day, throughout the trading day. So at this exact moment, when you sell, the bond is worth $890, and so you divide, you get 0.07, and so 7.58%. Okay, that would be your current yield. And okay, and the current yield is higher than the 6.75% stated interest rate because the bond's current market price of $890 is less than its $1,000 face value. Anyway, there's a bazillion things that you can study about all this, and learn more about stocks and bonds, and when to buy and when to sell, and of course, as you talk to different people, you're going to hear a lot of different things that contradict. Okay, so yeah, you're going to want to do your own research and hopefully find somebody who really knows what they're doing that you can trust. I did, and that helped me, and so I've definitely bought some stock and bought and sold, and made a little money. Didn't I need to get back into that. Anyway, that is it. So I hope that helped.